Welcome to our CFP Exam Prep podcast. Today we're diving deep into compensation models in financial planning, a crucial topic that frequently appears on the exam and often trips up candidates. Let's break down the three primary compensation structures that financial planners use. Fee-only advisors are compensated solely by their clients, receiving no other form of payment from any other source. This means they don't accept commissions, referral fees, or kickbacks from financial products. Many candidates make the mistake of confusing fee-only with fee-based, which can cost you valuable points on the exam. Speaking of fee-based compensation, these advisors can receive both fees from clients and commissions from financial products. A common exam scenario involves identifying potential conflicts of interest in fee-based arrangements. For example, an advisor might recommend a mutual fund that pays them a commission when a lower-cost alternative might better serve the client. The exam often tests your ability to spot these nuanced conflicts. Commission-based advisors earn their income primarily through the sale of financial products. The exam frequently presents questions about required disclosures for commissioned sales. Remember that registered representatives must always disclose their commission structure before completing a transaction. A typical exam question might involve a scenario where an advisor fails to properly disclose their commission structure before selling a variable annuity. Now let's focus on specific disclosure requirements, as they're heavily tested. All advisors must provide Form ADV Part 2A and 2B to clients. Part 2A details the firm's practices, fees, and potential conflicts of interest, while Part 2B focuses on the individual advisor's background and qualifications. Many test takers forget that Part 2A must be offered annually to existing clients, while material changes require prompt disclosure. A critical concept often tested is the timing of disclosures. Fee discussions must occur before or at the time of engagement. The exam might present a scenario where an advisor discusses fees after implementing recommendations. This is incorrect. All material conflicts of interest must be disclosed up front. Here's a key distinction that appears frequently on the exam. Fee-only advisors must be truly fee-only across all business activities. If an advisor claims to be fee-only but receives insurance commissions through a separate business entity, they're violating the rules. This is a favorite trap question on the exam. Some practical examples of fee structures include assets under management fees, typically ranging from 0.5% to 1.5%, fixed retainer fees, and hourly rates. The exam might ask you to calculate fees under different scenarios. For instance, if a client has $2 million under management with a tiered fee structure of 1% on the first million and 0.75% on amounts above that, you need to calculate $10,000 plus $7,500 for a total of $17,500 annually. To wrap up, remember these key points. Fee only means no commissions whatsoever. Fee-based allows for both fees and commissions. All compensation arrangements must be clearly disclosed up front. Form ADV requirements include annual delivery and prompt disclosure of material changes. And finally, conflicts of interest must be disclosed regardless of the compensation model. When preparing for the exam, focus on scenarios involving multiple compensation models and disclosure timing. These questions often require you to identify violations or proper disclosure procedures in complex situations.